Can a company that was, well, built on just mimicking human clicks possibly survive the rise of autonomous reasoning AI agents?
Yep.
That is the central paradox facing UiPath or Path today. It's really a defining moment, not just for them, but for the entire enterprise software landscape.
It's an existential question,
Hmm.
and the stakes couldn't be higher. We are talking about a company that IPO'd at a, what, $35 billion valuation?
Right. And now it's trading at a massive discount.
A massive one. The market has priced in a lot of fear. So is Path, trading at $13.86 as of December 1st, 2025, a deep value opportunity priced for disaster, or is it a classic value trap?
One that's just destined for commoditization by, the trillion-dollar titans like Microsoft.
I'd say.
That is the mission for this deep dive.
Yeah.
We're applying a modified value investing framework to dissect the business, the management, financials, and risks, all anchored strictly to the data available today.
And we want to give you the clarity needed to understand the core thesis.
We found something fascinating, a significant implied margin of safety but, and it's a big but, it comes with a high degree of execution risk.
Yeah, we really need to understand exactly what they're doing to fight back against the apex predator, which is Microsoft. This requires us to look beyond just the surface level number.
Right, and into the strategic heart of their business pivot. So let's get into the structure.
Chapters 1 to 3, business, management, and financials.
Business understanding.
Okay, so UiPath started as the undisputed leader in robotic process automation, or RPA.
Right.
Their whole legacy is building tools that reliably imitate human clicks to move data between systems.
Yeah.
But they've recognized that simple imitation is it's not enough anymore.
Well, they had to. So they've pivoted aggressively in fiscal years 25 and 26 to what they're calling agentic automation.
Which is a big shift.
A huge one. Essentially, they're transforming from a simple tool vendor into a full enterprise-grade software as a service or SaaS platform. Their revenue architecture reflects that.
So most of their income comes from subscription licenses.
The vast majority. It's tracked by their annualized renewal run rate, or ARR, and as of July 31st, 2025, that ARR hit $1.723 billion.
And it's important to note how they maintain their pricing power. Right. They intentionally limit their professional services revenue.
That low margin stuff.
Exactly, the implementation work. Instead, they rely on their partner ecosystem, Deloitte and others, to handle the heavy lifting of scaling delivery. That focus keeps their gross margins elite, which we will definitely get to later.
So the platform itself is now organized into 3 key layers: discover, automate, and operate. But the 2 crucial components that define this aggressive pivot away from old RPA are the new capabilities within automate and operate.
Right. So in the automate layer, they introduce what they call UiPath agents. This is where they marry the old deterministic bots.
The strict rules-based guys that don't make mistakes.
Hit them. With the probabilistic large language models, or LLMs. For listeners less familiar, LLMs are the brains like GPT-4. They're great at reasoning and interpretation, but they can't. Well, they can hallucinate.
Make things up. And this hybrid AI approach is the key differentiator. They're combining the creative intelligence of the LLM with the rigid, reliable execution of the RPA bot.
Which lets them handle complex, nonlinear workflows that simple rules-based bots could never touch.
Exactly.
And then the brain that manages this whole operation is in the operate layer, UiPath Maestro.
Maestro is the new governance and orchestration layer. It's like the central nervous system. It manages all the handoffs, telling a human when to step in, the robot when to stick to the rules, and the new AI agent when to apply its reasoning.
Okay, so this brings us to the competitive landscape. I mean, UiPath isn't just fighting rivals anymore.
No, they're fighting platforms. Microsoft, with its bundled Agentforce and Copilot Studio, is absolutely the apex predator. They're offering good enough automation bundled for free to millions of customers.
So why doesn't Microsoft just kill UiPath? This is where the core value proposition of UiPath comes into play. Safe orchestration.
Right. LLMs are fantastic brains, but they don't have hands to reliably touch legacy enterprise systems like SAP, mainframes, or old CRM tools.
So UiPath provides the essential link. The body, which is the RPA integration, needed to physically operate in those old systems.
And the manager Maestro to ensure compliance and accountability.
And that manager layer, Maestro, is actually a huge regulatory tailwind for them. With tightening rules like the EU AI Act Enterprises must have auditable logs.
You have to prove what the agent did step by step. And a lot of the end-to-end AI offerings are just black box solutions. They can't provide that compliance. UiPath can.
Which creates a structural moat, right?
It does, and it's reinforced by that sticky customer base, over 10,000 customers with automations embedded deep in mission-critical processes. You can't just rip that out.
And didn't you say they have another unique asset?
They do, proprietary computer vision AI.
And let's explain why that matters.
Yeah.
A lot of big companies run their systems on virtual desktop environments, Citrix, VDI, things like that.
So the robot isn't interacting with code, it's interacting with the screen image. UiPath's computer vision lets their bots reliably see and click on elements within that screen capture.
Which is a capability that is crucial for complex legacy IT setups where, standard code access is blocked.
And it's where Microsoft's simpler code-level tools often just fail.
Management evaluation.
Let's turn to leadership. The dominant narrative here is the return of co-founder Daniel Dines as CEO in mid-2024. He replaced Rob Enslin.
It's a classic founder mode crisis response. They're basically admitting that surviving the AI shift required the original visionary to come back and take the helm.
But that has a downside, doesn't it? The leadership flip-flop from Dines to Enslin and back again.
Well, yeah, it signals strategic instability to the market. Yeah, probably to the employees. You don't make those switches when you're feeling confident.
Right.
But the upside is management's recent candor. They've admitted to execution issues, and they've reset market expectations to a much more realistic, though, concerning 10% growth rate.
And their capital allocation seems focused. They aren't doing massive dilutive M&A. They're pouring R&D into that AI trust layer and the Maestro platform.
Which brings up a crucial point from a value investor perspective. Shareholder returns. They expanded their share buyback program by $500 million.
And they've been active with it.
Very. They bought back 8.3 million shares in Q2 alone at an average price of around $12.10. Since our intrinsic valuation is higher than that, it shows management is allocating capital prudently. They're buying when they think the stock is cheap.
But let's look at the flip side of their financial efficiency. Their return on invested capital, or ROIC, is currently negative. It's at negative 4.07% on a trailing 12 months basis.
Exactly. And that reflects this high investment phase for the AI pivot. The negative ROIC is, you could say, a feature, not a bug, of a growth company that's prioritizing R&D over short-term profits.
So the expectation is that it turns positive soon.
It is. As their free cash flow, or FCF, generation matures, they're projecting FCF to be well over $300 million for fiscal year 2026.
Okay, before we move on, we have to address the elephant in the room regarding governance. We mentioned Dines, but the ownership structure is, well, it's extraordinary.
That's Chapter 5, but you're right. Let's bring it up now because it really affects management trust. UiPath has a dual-class share structure where Daniel Dines holds Class B shares with 35 votes per share.
35 votes. So what does that mean in practice?
It means Dines controls approximately 87% of the total voting power.
87%. That is massive power concentration. So as a minority shareholder, you have virtually no say in strategic direction.
None.
So investors are basically making a high-stakes gamble on the benevolence and capability of one single person.
You absolutely are. You are betting that Dines is a benevolent dictator who will act in the best long-term interest of the company. The prudent buybacks we just mentioned are a strong point in favor of that, but yes, the governance risk is a structural weak point.
Financial health.
Okay, let's ground ourselves in the current financial context. UiPath's market cap is sitting around $7.36 billion.
Which is just a massive compression from that $35 billion IPO high.
Absolutely. The market is priced in both the general SaaS bubble deflation and, more importantly, the AI obsolescence risk.
And the primary drag on the stock price is that severe revenue deceleration. We've seen growth slow from, over 20% down to an estimated 10% for FY 2026.
The market is waiting for proof. Concrete proof that the agentic AI pivot can re-accelerate that growth back towards a premium SaaS rate.
But despite the deceleration, the quality of the business model is still elite.
It is. Non-GAAP gross margin remains consistently high, between 83% and 85%. In the software world, anything above 80% is considered best in class. It signals strong pricing power.
And they are now a financial maturity story. They're generating substantial, consistent free cash flow, around $306 million TTM. The business is self-sustaining.
And the balance sheet provides a fortress against that Microsoft threat. They have virtually no material long-term debt. The debt-to-equity ratio is negligible at 0.04.
And liquidity.
It's exceptional. A current ratio of 2.95. That means they have nearly $3 of short-term assets for every $1 of short-term liability. They have the capital to execute this transition.
Okay, let's look at valuation using relative metrics first. The stock trades at 4.9x price to sales.
Which is heavily discounted compared to peers. Salesforce is at 6-7x, Microsoft is at 12x. That discount tells you the market is focused entirely on that 10% growth rate and the competitive threat.
But the real core in is intrinsic value.
Right. We ran a discounted cash flow model. To account for all the volatility and risk, we used a pretty high discount rate at 12.53% WACC.
And here is where we need to justify the core assumption. If revenue growth is only 10% for FY 2026, how can we possibly assume a 15% free cash flow CAD/ER for the model?
That's a great question, and the difference comes down to margin expansion and sales efficiency. The 15% FCF-CAGR assumption isn't based on rapid revenue reacceleration, but on the expected operating leverage kicking in.
So as they slow hiring and R&D spending stabilizes.
Exactly. That elite 83% gross margin will flow much more effectively down to the bottom line. So we assume prudent expense management offsets the slower top-line growth.
So under those assumptions, what does the model give us?
The model yields an intrinsic value range of $17.63 to $17.85 per share.
And compared to the current price of $13.86, that means the stock is trading at an implied 20 to 27% margin of safety.
The fundamentals suggest the stock should be significantly higher, but only if that agentic pivot is executed successfully.
Like and subscribe to Stock Analytics AI.
For $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion.
Market sentiment.
Wall Street consensus is highly cautious. It's sitting at a resounding hold. Around 79% of analysts rate the stock that way.
And the price targets reflect that.
They do. They're hovering right at the current trading price between $13.69 and $13.80. The analysts are basically telling us they are on the sidelines. They need concrete proof of agentic AI ARR generation before they'll move to a buy rating.
And the bearish view is expressed through short interest, which is moderately high at 10 to 13.5% of the public float.
That signals a significant contingent betting aggressively on Microsoft's success and UiPath's demise.
But that high short volume also creates the technical setup for a potential short squeeze if we see a positive earnings surprise.
Absolutely. And technically speaking, the stock is in a very tight consolidation zone right now. It's compressed between the 50-day moving average at $14.53 and the 200-day support at $12.56.
It's coiled up.
Exactly. This tight compression suggests a volatile move is likely when news hits. The market is balanced on a knife edge, and the trigger will almost certainly be the upcoming Q3 earnings report on December 3rd.
Ownership structure.
As we touched on earlier, let's detail the ownership structure. The base itself is pretty robust. Institutional ownership is at 61.7%.
Yeah, including major players like Vanguard, BlackRock, and even Cathie Wood's ARK. This signals that smart money views the asset as legitimate despite the volatility.
But we have to circle back to the governance risk we identified earlier.
The dual-class share structure, it gives Dines 87% of the voting power. This isn't just about strategy, it's about absolute control. He can effectively veto any major decision, sale, or merger without any minority shareholder input.
This concentration really changes the investment dynamic. You are betting entirely on the founder's judgment.
You are.
But we should address the systematic insider selling we've seen recently.
Right, that's a necessary clarification. Dines has been selling shares in late 2025, but this is being done under what's called Rule 10b-5-1.
And for the listener, that's a pre-scheduled trading plan.
Exactly. It's used by executives to sell a predetermined number of shares at predetermined times. It's not based on sudden negative news or a loss of faith. It's usually for personal financial diversification.
Still, it can dampen market confidence. I mean, it does signal he's taking profits off the table, which it kind of contrasts with the company's aggressive stock buyback program.
It does. It's a subtle conflict of interest that's worth noting.
Risk assessment.
Let's structure the risk profile using a quick SWOT analysis. On defense, the strengths are clear. That sticky installed Fortune 500 base, the cash-rich balance sheet, and that best-in-class computer vision tech for legacy automation.
Okay, and on offense, the opportunities are also compelling. Maestro becoming the standard for agentic AI governance is the main one.
For sure. And the other massive opportunity is their partnership with Deloitte. This creates a huge funnel for the mandatory SAP S/4HANA migration projects which have to be done by 2027.
Migrating complex systems always requires a ton of automation.
And UiPath is perfectly positioned to capture that mandatory spending.
Okay, now for the threats. The existential threat is, of course, Microsoft bundling good enough automation.
Right. If Microsoft can integrate a compliant, stable Copilot Studio agent that is free and good enough for 80% of enterprise needs, the value proposition of a dedicated, high-cost platform like UiPath, it collapses.
And then you have the macro threats. The 2025 tariffs on hardware are squeezing corporate IT budgets.
Yeah, when core infrastructure costs go up, CFOs look for cuts in discretionary software projects, and automation software often falls into that bucket. This adds pressure right when UiPath needs to prove its growth.
And finally, that unique geopolitical risk.
That's right. A significant portion of their R&D and support is centralized in Romania. Now, while Romania is a NATO member, its proximity to the Ukraine conflict zone creates a perception of geopolitical risk.
Which could translate to higher insurance costs, trouble attracting talent.
Exactly. It raises questions about infrastructure reliability during times of global tension, the risk factor. So, to synthesize our findings, let's look at the financial and business tests. The stock passes the financial health and valuation tests. We found that 20 to 27% implied upside, and the company is financially sound.
Right. The primary hurdle remains the business test. Surviving the Microsoft siege on their moat and successfully executing that agentic pivot. They have to prove that their safe orchestration is indispensable.
Not just a nice-to-have niche add-on.
Exactly.
So we have two distinct outcomes. The bull case says UiPath is the adult in the room. They provide the brakes and steering wheel, the governance and orchestration that enterprises need to safely deploy AI.
They're the regulatory shield. The bear case, on the other hand, argues that RPA is fundamentally obsolete, Microsoft wins the bundling war, and that 10% slowing growth is structural.
Making the stock a classic value trap, a deeply discounted asset that deserves to be discounted because it's a dying business model. However, the current price of $13.86 already reflects extreme pessimism regarding that Microsoft threat. This is why the margin of safety is so crucial here.
Absolutely. If the market saw only 10% growth with no competitive risk, the price would be much, much higher. That pessimism provides the opportunity.
So the final verdict is?
Neutral to bullish. The long-term investment hinges entirely on the success of their hybrid AI approach and Maestro's ability to become the required standard for regulatory compliance in complex enterprises.
And the pivotal moment is just around the corner. The market needs concrete proof that the agentic pivot is translating into new recurring revenue. All eyes are going to be on that Q3 earnings report on December 3rd.
That is the critical piece of information that will determine if this $13.86 price is a disaster or a generational bargain.
Like and subscribe to Stock Analytics AI.
This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.